You are watching Darasa Online.
Welcome to Darasa Online. My name is Victor Francis, the accountants teacher. We are still going with our revision series. And in the last session, we had a lesson concerning centralized branch, where, of course, we did some questions. The first lesson, we did one question and a double column method. The second question we did in the second lesson under branch accounting, where we did a question also under stock and data system. We did one question. So far we are receiving your questions through our email and through the phone. You see the number that is passing through on our screen. So continue asking questions, give your comments, and we'll be answering them accordingly. Today, we are going to have another lesson in the same topic of branch accounting. And basically today, we are going to highlight on autonomous branch. Of course, as we said previously that our revision will cover on dependent branch and independent branch. And in the two lessons, we discussed about dependent branch. Today, we are going to have another lesson on independent branches. So what are these independent branches or autonomous branches? So these are basically branches that maintain their own set of books. Why do they maintain their set of books? Because so the operation under these branches are large enough. So the head office gives autonomy to the branch manager to employ competent personnel and to operate in its own, although the branch will still under the control of the head office. As you can establish here, these are sometimes referred to as autonomous branches, and such branches can either be home or foreign branches. So the accounting method, of course, are the same in both the case, except that for foreign branch, so they will prepare a trial balance. Normally it will be at the local currency of that particular country, and finally this will be converted to the currency of the head office. But if it is home branch, automatically all records will be prepared at the local currency, and that local currency will be of the same with the head office. So there is no need of conversion. So the branch will prepare its own set of books, and finally will prepare a trial balance and income statement. Then these income statements or financial statements will be transferred to the head office for incorporation or to be consolidated with the other branches and prepare the combined business financial statements. What are the features of these independent branches? So, as I said, this branch keeps a complete set of books. And beside, so they will be receiving goods from the head office, but also the branch is given autonomy to have or to secure a purchase from outside parties. But also, the branch normally prepares its own trial balance and financial statements and then send the copy to the head office for incorporation in the head office books. So this branch maintains a head office account. In its books, we call it head office current account. And this is a nature of a personal account from which all transaction relates to head office and relates to head office are recorded in this account. Of course, likewise, the head office also will maintain a branch account. We call it branch current account. And of course, it will record all transaction relates to branch in this account. It may be that it might happen that there is inter-branch transaction. The head office may own more than one branch. So for any inter-branch transactions, each branch may open a separate account for each of the other branches or record transactions with the other branches on the same pattern as if the transaction are with the head office. So if the branch will be operating with other branches, so they will open the same accounts as if it was with the head office. Before we go on, looking how we can solve question from this particular part, there are things that I need to emphasize, things to note. So far, we have seen in the features that the head office will prepare an account known as branch current account. How this account operates. So this account is treated as a debtor. The branch will act as a debtor to the head office. And this will form part of the double entry records of the head office. So this account will be debited with transfers made to the branch and will be credited with receipts from the branch, and it will be also credited with profit made by the branch since the branch belongs to the head office. So we have also head office current account. This is maintained by the branch. In this account will be treated as a creditor. So we know how it operates. So it will represent the indebtedness to the head office by the branch. What is recorded in this account? So it is credited with all receipts from the head office. It may include fixed assets, stocks, cash, and etc. sent to the branch. And of course, it will be debited with transfers from the branch to the head office. These are the current accounts. But again, doing questions under autonomous branch, there is issue of accounting for item in transit. What are these? Normally, when the head office transfers goods to the branch, so it may reach a time the financial statement required to be prepared. Some of these goods may be either still in transit from the head office to the branch, or the branch may return the goods to the head office for some reasons. And when the financial statements are prepared, so these goods may be still in transit. They have not yet reached to the head office. So items in transit are items which are still in transit. And these at the end of accounting period, either from the head office to the branch or from branch to the head office. They are normally goods sent or returned. It may also be cash remittance from branch to the head office. And that's goods sent from the head office to the branch still in the transit. So also goods returned by branch to the head office and still in transit. And at the end of the accounting period, also the cash remittance for branch to the head office still in transit. So this needs adjustment in the branch current account. And also we shall see in the financial statement how we are going to adjust this. What are the adjustments to be made in the income statement? So far, because the branch will prepare its own set of accounts, and of course we are going to consolidate it in the head office books. So we have head office income statement, branch income statement, and a combined income statement. What are the adjustments to be made in the income statement? So in preparing the combined income statement or statements, the head office and the branch are treated as one company in the combined income statement. However, so there will be intertransfer between the two, the branch and the head office. So if there is any intertransfer of goods, that includes sales and purchases, goods sent and received. So they are not treated as sales or purchase. Rather, the only sales that are recognized are those made outside of the firm. So these goods sent and goods received will be treated as inter-entity transaction. So they are going to be eliminated in the combined income statement. So the only purchase that will be recognized either from the branch are those that are coming from outside the company. So there is issue of unrealized profit. If normally in opening a balance for goods sent to branch, the opening balance of stock and the closing stock contained unrealized profit that we shall come and see it later. So there is a need to do adjustment in this unrealized profit. When goods are invoiced at a price above the cost to the branch, and when these goods are returned and sold, for any return from branch to the head office, or remain unsold, that is closing stock at the branch premises. So if there is goods which are in transit to the branch, so then the head office will lose such kind of profit loaded, and it should be termed as provision for unrealized profit, because as we are preparing our financial statement, these stock are still unsold. And of course, because we send them at selling price, so there is a need to adjust for unrealized profit to reduce it in the profit loaded. So, and this should be adjusted from the head office income statement. We shall see it, how we do. But basically, again, there might be branch expenses paid by the head office. Normally, if the branch prepares its own set of books, so it will pay its own expenses. But sometimes the head office may pay some expenses for the branch. For any expenses invoiced by the head office for the branch, they should be transferred to the current account in the respective ledger. So we shall see it. What are the adjustments to be made in the financial statement? The statement of financial position. So, as I said, we are going to open head office, branch, and the combined statements of financial position. So if you are preparing statements of financial position, there are entries that need to be adjusted. For example, record the current account value of profit for unrealized profit in the liability side. The unrealized profit after being adjusted should be recorded in the liability side of the head office only, not in the combined, because in the combined, entry entered at cost. So far, there is no need of adjusting this. So it will be adjusted in the head office column. Likewise, the goods in transit, they should be recorded at invoice price in the head office column. So, but again, in the combined statement of financial position, all transfers to combined statement of financial position should be converted at cost. And of course, we are going also to offset the inter-entity transaction. That means the current account, as I say, that branch current account acts as a debtor. So in the financial statement of financial position of the head office, it will be shown as a debtor. Likewise, the branch will show the head office current account as a creditor in the financial statement of financial position. But in the combined business, because these are inter-entity transactions, they are going to be eliminated. Basically, because the branch current account has debit balance and the head office current account has credit balance, automatically, even if you transfer them to the combined statement of financial position, they're going to offset. There is no need of showing them, just like as we have seen in the income statement when I was just explaining treatment for goods sent and goods received. All of these are inter-entity transactions. So they are going to be offset in the combined financial statements. Let us now see how we can solve a question on this part. We have seen how the operation of autonomous branch can be done. Let us now an illustration, a comprehensive question that covering all this part, but basically when goods are sent at selling price. Let us read the question. Gentro Limited presented the following forbearance for the head office and its branch is at 31st December 2003. You are given the Gentro Limited trial balance at that date. We had head office column and branch column. Amount is in TZS. We have cash, head office 43,000, while the branch is 15,000. Debtors 22,000 and the head office 20,000 and the branch. Stock at 1st January 2003, 15,000 head office, 12,000 branch. Branch current account 50,000 in the head office column. Other assets are given. There is 14,000 and 59,000 for branch. Purchases was 65,000 at the head office. Goods received from head office, branch column 30,000. Expenses, head office 7,000, branch 4,000, making a total of 216,000, head office and branch 140,000. The liability and equity side, we have liabilities 18,000 by head office, 12,000 by branch. Capital by head office 50,000. Retained earnings 10,000 head office. Head office current account and a branch 47,000. Sales for branch was 100,000. Branch 81,000. There is a goods sent to branch 36,000. provision for unrealized profit on stock, 2,000. And our head office, making a total of 216,000 and 140,000 for branch. We have additional information. Part A, the branch obtains all goods for resale exclusively from the head office, and the head office bills the shipments to the branch at 20% above the cost, and this is the markup. Stock at 31st December 2003 were TZS 10,000 at the head office and 4,800 at the branch. Part C, there was a branch debtor who had sent TZS 3,000 directly to the head office. And the head office recorded this amount correctly, but the branch accountant was not aware and had just been informed after preparing the above trial balance for the branch. So we are going to adjust this in the head office current account under the branch. So the difference in goods sent and goods received accounts relates to goods in transit from head office to the branch. So from the information provided, we are required to prepare Roman 1, head office current account and branch current account. Roman 2, in columnar form, the income statements for head office, branch, and the whole company. Roman 3, in columnar form, statement of financial position for the head office, branch, and the whole company. So before I go on solving this question, I would like basically to highlight some key issues. So under autonomous branch, you will be required in most times to prepare these current accounts, the head office and the branch current accounts. But also you will be required in most times to prepare statement of financial position and a statement of profit or loss, either combined or separately. But in most questions, the statement of financial position are asked in combined. They combined. But basically for this question, we are going to prepare individual, that the head office, branch, and the combined. So you have advantage of it that you can use that concept even if you are required to prepare only the combined. So we are almost going to cover all these parts. So let us now see what we can do. So as we know that in the head office current account and the branch current account, there will be profit to be transferred to this account, especially the branch profit. So there will be an item to be transferred to these two accounts that comes from the income statement. And basically, let us now start with the income statement. Then we are going to reopen again after the income statement. We are going to open up now these current accounts. Let us have a short break. As I come back, we start solving our question. Well, my dear students, we have read the question. Now let us go on solving it. So let us start with preparing the income statement. This is Gentle Limited statement of profit or loss for the year ended 31st December 2003. So the amount in TZS. So this is head office, this is branch, and this is combined. We start with revenue. So with sales, that is revenue. Sales was 100, for head office 81, for the branch if you total you get 181,000. So goods sent constitutes part of sales to the head office. Goods sent was 36,000. Because this is an inter-entity transaction, you want to be shown in the combined. We add up to get total revenue. It will be 136, 81, 181 here. Let us go this, and we go for computing cost of sales. Opening stock. Opening stock, we are given head office 15,000, 12,000 for branch. Remember, this has a profit loading of 20%. If you compute 20%, you convert it into margin, we get a margin of 1/6. So this will be the margin. If you times 12,000, you get the profit loading of 2,000. And that was shown as provision for unrealized profit in the trial balance. So we deduct or we list this profit loaded in the combined, because the combined income statement must be shown at cost. So if you add up, we get 25,000. What next? We add purchases. Purchases, we had 65,000. There are no purchases, so let us include goods received here, because will form part of goods available to the branch. How much the branch received? 30,000 from head office. So goods sent were 36, but received 30. Means there were 6,000 goods in transit. So this is also an inter-entity transaction. You want to be incorporated in the combined business, so you transfer here the 65,000. If you add up to get goods available, here we have 0, 7 plus that 8,000. Then here we have 42,000. Here we have 0, 9, 90,000. This is goods available for sale. So we less closing stock. Our closing stock, we are told that it is 10,000 by the head office. There are 4,800 at the branch. So as usual, we need to add. But here, in adding to get the total transfer to combined business, this also has a profit loading. So we need to adjust an realized profit in the closing stock. Closing stock of 48,000, 4,800 times 1/6. How much we get? The profit loading 4,800 times 1/6. We get 800. That was the profit loaded. So if you deduct, we get 14,000. But also there are goods in transit. These form part goods in transit. So far, goods in transit are no longer available in the head office because they are already transferred. But they are not even here. So because the branch not yet received. But they belong to the company. So we need to show them in the combined. Goods in transit was how much? 6,000. If you take the difference between goods sent and the goods received. So 6,000 is at selling price. If you compute the profit loading, you get 1,000. So less 1,000, we get here 5,000. So closing stock should be deducted. We put it in negative here. Of course, we have shown here less. If you deduct, you get how much? Here you get 70,000. Here we have 42,000 less 4,800. We get 37,200, yes. And here we have 90,000 less 14,000 less 5,000. We get 71,000. This is cost of sales. If you take now the total revenue less cost of sale, we get gross profit. Let us now compute our gross profit. So we have 136,000 less 70,000. We get 66,000. And we have 81,000 less 35,200. We get 43,800. We have 81,000. We less 71,000. We get 110. That is gross profit. We add with any other revenues. So if you go to our trial balance, we have cash, data, branch current account, other assets purchases, goods received, expenses. So in the liability side, we have liability, capital, retained earnings, head office current account, sales, goods sent, provision. Okay, so we have only one entry, expenses. expenses, we are told that with expenses, we have 7,000 head office. We have 4,000 branch. But we go on additional information if there is anything. Okay, so in the additional information, there is no adjustment. So we add up those expenses. If you add up, you get 11,000. But we need to compute the adjustment for an unrealized profit. So far, let me illustrate here. So we have an realized profit account. So we had a balance. The balance was 2,000 from the books. We have also ending balance. Ending balance, that is an unrealized balance at the end of the period, 8,000 for goods for closing stock and 1,000 for goods in transit. We have 18,000. So if you check here, you find that it has decreased from 2,000 to 1,800. So it has decreased by 200. This goes to income statement. So there will be decrease in unrealized profit. So we enter here unrealized profit. It's again 200 because this belongs to the head office and not in the the branch. Branch is recorded at selling price, and also the combined is recorded at cost. So unrealized profit will be adjusted only at the head office. Afterward, because we have almost finished all items, so we have the profit here. The profit will be 66 plus 200, yes, less 7,000. We get 59,200. We have 43,800 less 4,000. We get 39,800. We have 110,000 less 11,000. We get 99. So after adjusting for an unrealized profit, that will be our profit. So the total must be equal. Let me confirm 59,200, the total profit for branch and head office, plus 39,800. Yes, it is 99. But remember, this profit should be transferred to the head office. So we put it here, transfer of profit. So we transfer to head office 39,800. To transfer this, we put it in negative. Here, it cancels. There is 0. But remember, we had retained the profit. So retained the profit was 10,000. So what will it be? Now our retained profit to be carried forward. So you add up here, you get yes, 109, and also here you get the same 109. Okay, so we can now prepare our current accounts. The question required us to prepare current accounts. We open now in the books of head office. So in the books of head office, we are going to prepare branch current account. And this, we say that acts as a data. So we place the balance here. We had our balance. The idea was how much? Branch current account was 50,000. So you open up again. In the books of branch, you open up head office, current account. So the balance will be here on credit side because it acts as a creditor. Balance brought down, we are told that it was 47. Why 47? They are not equal. Because we are told that there was a debtor who sent money direct to the head office and the branch manager was not aware. So we need to adjust this again to make the balance of head office current account and the branch current account equal. So their transfer to head office by data, that was 3,000. That was by customer who sent. So this amount will reduce the balance available to head office. I mean, in the head office current account. Of course, we have remained with the, yes, 344, yes. 44, if you compare with this, we get 6,000 the difference. That was the goods in transit. So far, we enter the profit. This profit should be also recorded in current account. We call it net profit. That was 39,800. Net profit 39,800. They are goods in transit. You are just here. Goods in transit was 6,000. So balance your current accounts. They are supposed to be equal. If you add here, we get how much? 50 plus 39, yes, 89,800. 89,800. 89,800. less 6,000. We get 83,800. So what will be our balance? CD. If you add up here 47,000 plus 39,800, you get 86,800. 86,800. If you less 3,000, you get 83,800. Okay, so our branch current accounts balances. Okay, let us now quickly go and open up our head office, our balance sheet or statement of financial position. So remember, this balance will be used in the statement of financial position. Let me clear this part. Okay, we are in Gentle Limited is statement of financial position as at 31st December 2003. So amount in TZS. So we have, okay, remember that this should be in in columnar form. So we prepare 3 columns. So we have head office in TZS. We have branch TZS. We have combined. Okay, the amount in TZS. Okay, so we start with the non-current assets. So if you refer to our question, we had no non-current assets, rather we had other assets. We put it other assets apart from current assets. As other assets, well, yes, we have 14 for head office and 59 for branch. If you add up, you get how much? 14,000 plus 59, you get 73,000. Okay, so no adjustment for accumulated depreciation. So far, we had no other non-current assets. We got for current. If you go to current assets, we have stock. Stocks, ending inventory, we are 10,000 here. Here we are 4,800. Remember to adjust for unrealized profit, that was 8,000. You get 14,000. You may transfer from the income statement. So we have these, yes. There are goods in transit. Goods in transit, they are no longer here. We have here 5,000. But remember, he said that in the explanation, these goods in transit belongs to the head office. So, and because they are sent at selling price, we need to incorporate them as a part of assets to the head office. Apart from that, there are debtors. Debtors for the head office were 22,000. The branch were 20. But remember, there were a debtor who sent money direct to the head office. If you adjust this, will remain with 17. So add 17,000 plus 22, we get 39. Apart from data, we had, yes, cash. Cash head office were 43,000. But remember, before that, we need to enter the branch current account because it acts as a debtor to the head office. Branch current account. Branch current account, if you remember, it was a mini 43,800, I think. If you go through our current account. So it won't be shown here because it is an inter-entity transaction. We go for cash. Cash here we have 43,000. Here we have 15,000. If you add up 43 plus 15, we get 58,000. Then do we have any more asset? I think we have exhausted the side of assets. There is no cash in transit. If there could be cash in transit, we could have added it here. So we get the total assets. Let us make a total of assets quickly. It was 14,000 plus 10,000 plus 6,000 plus 22,000 plus 3,800 plus 43. We get 178 and 800. So here we have 59,000 plus 4,800 plus 17,000 plus 15,000. Yes, we get 95,800. We have 73,000 plus 14,000 plus 5,000 plus 39,000 plus 58,000. You get 189,000. So we go for equity. So we have our capital. The capital was for the head office 50,000. No capital here because this is a branch. So we recognize the capital to the combined. Yes, we have retained profit. So we have our retained profit 109. The profit was transferred to the head office, so 109. Do we have anything more in the equity? Okay. So we are through with equity, we go for current liability. For current liabilities, we have creditors. Okay, so creditors that are liabilities, they are shown as liabilities. Liabilities here, we have 18 for the head office, but for the branch, we are told that it is 12,000. If you have the total, you get 30,000. Okay, so we are through with this, but we need to recognize head office, current account as the creditor to the branch. The balance was 83,800, if you remember, and that is an inter-entity transaction. And finally, we have provision for an realized profit. That was should be adjusted here 1,800, if you remember. Then have the total. To balance your balance sheet. Okay, let us add 50,000 plus 109,000 plus 18,000 plus 1,800. Okay, we get 178,800, and we have 12,000 plus 83,008. We get 95,800. Okay, so far we finish up with 50,000 plus 109 plus 30,000. We get 189,000. So our statement of financial position balances. Okay, so far we have exhausted almost all the concept. So in this will mark the end of revision in the branch accounting. Remember to go through all those concepts that we have highlighted here, and we are still inviting you to give more comments concerning the session, concerning the today's lesson, but also ask questions through our email, ask questions through the number that is displayed. We are going to answer your questions. Otherwise, keep on revising, do more questions. You will find a number of questions of different technique, so solve them. So the next session, we are longing to have another topic, and definitely this could be in company accounting. Thank you for being with us. I wish you all the best. See you next session. Thank you.